Welcome back to the deep dive. You know how the news cycles just constantly throw financial volatility and market fear at you? Well, our mission today is to cut through some of that noise. We're going to analyze a stack of, frankly, urgent warnings, suggesting we're not just seeing normal market jitters, but maybe something fundamentally new. We're doing a deep dive into this concept of the everything bubble. The theory, essentially, is that asset prices, stocks, real estate, you name it, are simultaneously at historic highs, like wildly inflated. And this is despite some pretty clear weaknesses in the underlying global economy. We're looking at predictions from people like Jim Rickards, who are warning the next crisis could dwarf anything we've seen before.
And it's not just theory, right? Our sources mix these guru warnings with highly practical advice coming from official national institutions. What we really need to unpack is what are the specific measurable signs, the data points, the behavioral stuff that's making these institutional leaders genuinely alarmed right now?
Okay, let's jump right into those official warnings then, because they might be the most uh, jarring piece of this puzzle. We're looking at the Nordic nations, starting with Denmark.
Exactly. So the Danish central bank has publicly, quite explicitly, cautioned its citizen. They're saying don't rely exclusively on the digital financial system, online banking, cards, the whole setup. And the specific advice, that's what really stands out. They recommend people physically keep cash, about 250 Danish krone per person per day. And this isn't for rainy day savings. It's purely for necessities: water, food, medicine. Basically, if the financial infrastructure goes down or becomes inaccessible, even temporarily.
Wow, that's a pretty staggering recommendation, especially from a government that usually, prides itself on being so digital forward.
Yeah.
I have to ask, what's the specific threat here? Are they just talking standard disaster prep like for an earthquake or a flood? Or is something unique about their digital systems they're worried about?
That's the crucial distinction, yeah. The bank actually states Denmark's financial system is fundamentally secure and effective. So, no, they aren't preparing for just a standard recession or something. They seem to be preparing for a situation where the reliability of the system itself is compromised. Think advanced cyber attacks targeting financial centers, maybe widespread infrastructure issues that just freeze digital payments.
Right.
And when you have a society moving so fast towards being cashless, completely digital, the risk of one big central failure just shoots up, doesn't it? This whole preparation thing feels like a contingency for a breakdown of trust in that digital backbone.
And Denmark isn't alone in this. What you could call it paranoia, maybe? The Swedish central bank apparently issued similar guidance months earlier, urging citizens to prepare for events affecting financial stability. I mean, when two of the world's most advanced, digitally integrated economies tell people to hold physical cash,
Yeah.
it suggests something deeper, right? A systemic concern that goes beyond just normal market ups and downs.
Right. It absolutely does. It suggests they're planning for a potential break in that fundamental trust, the trust that underpins, well, fiat currency and all our digital transactions. And this ties right back into that everything bubble idea, this weird paradox where the underlying economy looks shaky, but somehow every major asset class is just wildly overvalued.
Okay, so to really get a handle on the danger level, we need some historical context. People like Jim Rickards are calling this potentially the biggest crisis ever. How does it stack up against, the big crashes we remember?
Well, if you look at the macro view, historically, crises tended to have a focus, right? An isolated excess. Think back. 1929, the Wall Street crash that devastated the stock market. Then you had the dot-com bubble in 99, 2000. Again, stock market, specifically tech stocks getting crazy valuations.
Right, and then the most recent big one, 2008, the subprime crisis. Most of us remember the global stock market meltdown from that. But the trigger, the origin, was really the real estate collapse, wasn't it? Which then pulled everything else down with it.
That's the critical point. Historically, it was either stocks or real estate that was a core problem. What makes now so unique, what some are calling bubble by two, is this simultaneous, really clear bubble forming across both major asset classes, stocks and real estate, at the same time.
And the charts we've looked at, the 2025 data, they show current stock market valuations have actually sailed past the peak of the dot-com bubble, that old high watermark. It's officially behind us now. Okay, let's unpack this with some hard numbers, because just saying bubble is kind of useless without specific indicators showing this extreme overvaluation. We've got three pretty powerful ones here that seem to be screaming, well, irrational exuberance.
Yeah, let's start with price to book value, PDV. This basically compares a company's share price to its actual accounting book value, the tangible assets, the real stuff on the books. It's a pretty clean measure of how much extra investors are paying based on hope, maybe, rather than substance. Okay, so the current S&P 500 average PBV, it's 5.3 times. Now get this. During the absolute peak frenzy of the dot-com bubble, famously overvalued, right, the PBV hit 5.1 times.
Wow. So just based on tangible assets, we're currently paying more for the average S&P 500 company than people did at the absolute height of the 2000 tech mania.
Exactly. And just to ground that a bit, the historical long-term average PBV for the S&P 500, going back to like 1946, it usually sits around 2. So 5.3 isn't just high, it's more than double the historical norm. It's way out there.
Okay, indicator 2, price to earnings ratio, the PE ratio. This one measures how quickly a company's earnings could theoretically justify its stock price. Tells you how many years of earnings it would take to get back your initial investment.
And the distortion here is, well, it's immense. Our data for the S&P 500 shows that a full third of the companies in that index have a PE ratio of 50 times, 50. That means based on current earnings, you'd need to wait half a century just to earn back what you paid for the stock.
Half a century. And that's not even counting the real outliers, right? We've seen those super popular high-growth names that sources mentioned, Tesla, for example, where PEs went totally vertical, 180 times, even 270 times earnings. The fundamental question is just, what kind of growth rate do you have to believe in to justify waiting 50 years? It demands this faith in permanent exponential growth that, well, history just keeps showing us isn't really sustainable long term.
Exactly. It's built on hope. And the final indicator really shows the sheer size of this market compared to the actual money floating around. We looked at the NASDAQ market cap versus the U.S. currency supply, specifically M2. So the NASDAQ market cap alone is over $50 trillion. Now compare that massive number to the entire M2 supply. That's basically all the cash and easily accessible deposits in the U.S. economy. The NASDAQ's valuation is 145% more than the entire M2 supply. The value of just one index is way bigger than all the readily available money that could theoretically buy it.
That just raises a huge question, doesn't it? You really have to think, if the metrics are this stretched, this obviously stretched, and the data is public, why are prices still going up? If it's such an obvious bubble, who is still pouring fuel on this fire? Who's buying?
Well, what's fascinating and kind of worrying is the clear split based on who is doing the buying and selling. We looked at a smart money versus dumb money analysis. This was based on Goldman Sachs research tracking ETF trades. Okay, so the dumb money, which generally represents retail investors, the public, they're showing a massive surge in buying activity. That line on the chart just goes straight up. Meanwhile, the smart money, the professional institutions, hedge funds, the sophisticated players, they're moving in the exact opposite direction. They are currently selling, divesting, dumping assets, essentially.
So the pros are taking profits, managing their risk, while the public is just aggressively chasing these already high returns. But, I mean, I have to challenge that slightly isn't dumb money sometimes, right?
Yeah.
Especially in a strong momentum market. How do we know this isn't just a healthy rotation, not necessarily a five-alarm fire?
That's a fair point. But the alarm gets much louder when you look at the most informed buyers, the ultimate insiders. Corporate executives. We looked at insider trading data, focusing on the top 200 insiders. These are the CEOs, the top execs, the people who usually buy the most shares in their own companies because they know what's really going on. And here's the key insight. Among those top 200 people, the current buy order volume is 0. 0 out of 200 trades are buys.
0. Yeah, that's chilling. The people with the deepest possible knowledge of these companies' real health and prospects, they're refusing to put their own money on the line at these prices. They know the price is just detached from the actual value. And this is where that history lesson becomes really relevant, isn't it? Because this pattern of behavior, it fits perfectly into the classic stages of a bubble. Jim Rickards outlines these 4 phases, and apparently this pattern holds true going way back, even to like 17th century tulip mania.
Yeah, the first 2 phases are long gone for us now. You had the stealth phase, where the smart money quietly bought up assets when they were cheap before anyone else noticed. Then the awareness phase, where institutions kept buying, and you start hearing whispers, quiet talk about big money being made. Right now, we seem to be locked deep in phase 3, the greed phase. This is the part marked by extreme public excitement, huge trading volumes, and just massive FOMO, fear of missing out. The fact that retail is surging in while insiders are sitting out or selling, that screams peak public greed.
And the final phase is the darn phase. That's the rapid sell-off, the liquidation that signals the collapse is starting. The fact that professional institutions are already showing significant outflows in that ETF data. It suggests the smart money has already started making for the exits, quietly.
And the other huge risk factor, which you touched on earlier, is the sheer concentration of all this capital. Sure, the S&P 500 is valued at a mind-boggling $49 trillion, but the danger is that the risk isn't spread out evenly across that whole index at all.
Absolutely not. The weight resting on just a handful of companies is, well, it's unprecedented. The 10 largest companies, you know the names: Apple, Microsoft, NVIDIA, Amazon, Meta, mostly driven by AI excitement.
Right.
They now account for one-third, a full third of the S&P 500's total market cap.
That's just massive concentration risk. Think about it. A third of the stability of the entire U.S. market relies on the continued perfect performance of just 10 companies. If only one or two of those hit a major snag, maybe a regulatory issue, maybe an earnings miss, the ripple effect, the systemic fallout could be immense.
And the scale of these individual companies is just staggering, too. The sources highlighted NVIDIA. Alone, NVIDIA currently has a market cap around $4 trillion. To give you some context for that number, that one company's valuation is equal to 3.7% of the entire global GDP. Just let that sink in for a second. We're essentially betting 3.7% of the world's total annual economic output on the performance of a single company selling sophisticated chips. If that one company stumbles, that instability gets exported globally, instantly.
So putting it all together, the data really suggests extreme overvaluation based on any traditional metric. You've got this clear split between the insiders and institutions who know the most and are selling, and the retail public who are buying aggressively. That divergence, that's like the classic hallmark of a bubble nearing its end, and that brings us right back to those Nordic warnings, doesn't it? Crises, historically, they don't arrive with a big flashing siren and a countdown clock. They tend to happen because of some small, often unpredictable event, a last straw kind of thing, maybe a minor default somewhere unexpected, a cyber event, a sudden regulatory change that just shatters confidence. And the entire value of fiat currency and these inflated asset prices, it all relies completely on trust.
So the most actionable advice, really, that we can pull from all this source material, it boils down to risk management, doesn't it? Basically, don't put unquestioning faith in a system that's showing such clear signs of being extremely historically overvalued and maybe unsustainable.
Diversification seems key. The advice points toward hedging against this potential systemic risk, the risk of the bubble bursting. How? By holding some physical assets, things that store value outside the digital or fiat system. Specifically, precious metals are often mentioned. The idea is, if the digital or currency systems falter, having assets you can physically hold, assets that can't just be printed or digitized away, provides a kind of fundamental insurance.
And that really leads to the final provocative thought for you, the listener, to chew on. If the smart money is actively selling out and the highest level corporate insiders aren't buying at all, what exact level of blind collective faith is needed for these prices to go even higher? And maybe more importantly, what tiny, unpredictable trigger could finally be the thing that breaks that faith and sends the whole system tumbling down? We'll catch you next time for the next Deep Dive.